Hello students. Today we have to discuss the last method of calculation of engineering projects. So that is your IRR. In the sense, internal rate of return. Means it is very clear concept out of this name to be suggested. That is IRR. What does it mean? Means return. Internal rate of return. Because each and every investor wants that after a lump sum period when they have to invest at a lump sum amount also, what the returning amount, that's a very important things here. So internal rate of return method to be suggested, so the returning amount is higher, then the project will be accepted. The very clear concept. So now you have to discuss the things of IRR. The rate of return is another method of discounted cash flow into present value or the comparison of the project. Discounted cash flow, one thing is here, you see here, discounted cash flow into the present value for the comparison of the projects, right? When both the projects are there, present value you have to compare, and discounted cash flow means discount amount you have to consider. It refers to a percentage that indicates the relative yield in the sense what, earning income on different users of capital, because you have to utilize the capital in the sense investment thing. Initial investment will be utilized in different segments, different ways, right? It indicates the relative earning is which one is good one, that you have to consider here, right? So there are rate of returns appear frequently in engineering economic studies, that is three cases will be there. So first one is your MARR, in the sense minimum acceptable rate of return. What should be the minimum acceptable rate, right? When you have to invest some amount, that's suppose you go to a bank, right? You invested because each and every person is interested to save their money in different financial sectors. That financial sector may be LIC, Life Insurance Corporation. That financial sector may be your bank, right? Just like fixed deposit account, you can say also. And postal also, and some private finance is also there. Some, so where you have to deposit it. First thing is your secure, that is the important thing. Another is the earning. So minimum acceptable return. That means what? Means there should be a minimum return amount will be there. Otherwise there is no value of investment. Then IRR, internal rate of return, and ERR, external rate of return, is also there. So our case is IRR. You see here, the IRR is the best known and the most widely used rate of return method, right? The most widely used in the maximum sector it is used, IRR. So it is also known as discounted cash flow method, right? So the IRR can be calculated by equating the annual present or future worth of cash flow to zero. Annual present, yearly present, and future worth, right? You have to equate these things with value is your zero. So IRR is the rate of interest at which the present worth of the cash flow of a project is zero. So it refers to the rate of which the present worth of receipt equal to the present worth of cost. So means what? C plus R1 by 1 plus I plus R2 by 1 plus I plus 2 plus up to, in that way, R1, R2, R3 up to Rn, because n in the sense number of time period, that may be R1 revenue 1, then 1 plus I to the power n is equal to 0. So here we will see C in the sense initial cost, initial investment, I in the sense rate of return, means your investment, out of your investment what should be the rate of return, 5%, 3%, 4%, in that way. Expected return also there. So IRR indicates the rate of return at which NPV, net present value, is equal to 0. So we can write the things under IRR, that is to be present worth revenue minus present worth cost, is must be 0. That IRR indicates. So IRR is discount rate. There is another discount rate is also there. That's R minus C plus R1 minus C1 by 1 plus I plus R2 minus C2 plus 1 I to the power 2 plus up to Rn minus Cn by 1 plus I to the power n is equal to 0. So when you to calculate IRR, right? There are different projects will be there. One is single project will be there, comparison project will be there. In the sense what comparison project means, two project must be available, and a single project in the sense one is single project. So when IRR, internal rate of return, when minimum acceptable rate of return more than acceptable minimum acceptable return, in the sense the project, that particular single project will be accepted. And the second case is here when an IRR, internal rate of return, is equal to minimum acceptable rate of return, MARR. That means what, either select the project or reject that project. It's depend upon the authority in different decision, it ultimately to say. Then IRR is less than MARR, internal rate of return is also less than minimum acceptable rate of return, so it will be reject the project. This is the uh, consequence of this project. Then come to when two projects will be there. Suppose project A and project B, two project will be there. So that is IRR, internal rate of return, A means project A here greater than IRR B, project B. So A will be selected. If internal rate of return A will be greater, then A will be, those project will be greater value, that will be selected. And when both the project internal rate of return will be equal, that is IRR A is equal to IRR B, so indifferent decision depend upon, cannot find out the decision, indifferent, either select or reject, that is to be. Then in IRR A, internal rate of return, and both the internal rate of return you see here, IRR A is less than IRR B, so B will be selected, right? This is the calculation purposes. Then another important thing we have to see here, and the maximum time we also get this type of valuable question in case of your exam, that is comparison between NPV and IRR, net present value and internal rate of return. Comparison in the sense what, comparison means it depends upon similarity as well as dissimilarities. In the sense similarities, dissimilarities, otherwise known as difference. So what are the similarities both the method? In NPV method, net present value method, and IRR method, internal rate of return, what are the similarities? The first bit, both methods are modern techniques of capital budgeting, right? Capital budgeting, when you to find out the budgeting, capital budgeting in the sense, budgeting in the sense what? Budgeting in the sense what? Future forecast, right? Suppose in our country, what should be the expenditure of the next year, so we make the budget in the parliament also, in state also, like that. So both methods are modern techniques of capital budgeting. Then both take into account the time value of money into consideration. Yes, because this is depend upon time value of money. Money has some value in time. So that is both take account of time value of money to into consideration. Both are also discounted cash flow technique, because both are depend upon the cash flow technique. Cash in or out. Both the techniques assume independence among the cash flow generated by cash project under consideration. So cash flow generated means what? Cash is generated cash project, because cash you to invested. Why the people will be invested cash? Because they want to generate the cash. That is the reason we can. Suppose we are investing so much money in our business. We are investing in infrastructure and different service sector also, because to generate the cash. So both the techniques assume independent, both are independent one, right? So cash flow generated project, this is the similarity. Then come to dissimilarities, or you say differences. So in case of differences, first one, in NPV method, net present value method, present value is determined by discounting the future cash flow of a project at predetermined or specified rate, that is called cutoff rate, because here interest rate is specified rate will be there is no chance of fluctuation. Suppose 10%, it is to be 10%. When you go to invest any money in bank, it is to be written that this much interest is given by the bank to that particular individuals. So that is predetermined or a specified rate of, that is cutoff rate. But in under IRR method, cash flows are discounted at a suitable rate by heat and trial. Because here what happen, heat and trial in the sense, here what happen, the interest rate will be changes. Here discount rate is not predetermined. Today 5%, next day your 15%, next day 10%, just like in that way. So a project discount rate will be, project value depend upon discount rate, and discount rate is also changing as per the suitable one. Then second bit, NPV method gives the importance of market interest rate. Yes, because as per the market interest rate it gives, but in IRR method it doesn't consider the market interest. Market interest may be whatever, IRR is not depend upon, it has its own interest, but the net present value is depend upon the market, because whatever the market interest are there, in that way the calculation will depend upon. But IRR, it has creates its own interest. There is no fixed interest, that is the reason it creates its own interest. Then third bit and the last one also, in NPV method intermediate cash flows are reinvested, means in intermediate time, in middle time also it again it again invested, reinvested. But in IRR intermediate cash flow is reinvested at IRR, means internal rate. Is considered here, rate is depend upon him. They also both are reinvested in NPV method, also intermediate cash flow is reinvested, in IRR method also intermediate cash is invested. But thing is that here, as we know, as we already discussed, that NPV method is already prefix interest rate, so it is depend on, if it is a suitable one, suppose interest rate is suitable one, then the people will be, then the individual will be interested to invest. But in case of IRR, it depend upon him, they also reinvested, but what is the interest rate, what is the returning amount, that is depend upon him. That's why they have to consider these things, select these things, interest is selected by them, right? Thank you, that's all.